Hello and good day. My name is Nurul Adwariana binti Abdul Jalil. My ID number is SMK22070216. So for the question number 1, this is the calculation I have made for Seri Meru ratio.
My name is Nur Balkis binti Tazali. My ID is SMK22070236. I am from DMK 5D. So moving on to the next part, which is ratios and its explanation. So let me start with liquid ratios. So for the explanation, Sri Meru Sdn Bhd have the ability to meet short-term obligation because Sri Meru Sdn Bhd has enough current asset, which is 3.81 times to pay current liability compared to industry average, which is 2.5 times. So for the financial leverage explanation, Sri Meru Sdn Bhd use more debt financing because Sri Meru Sdn Bhd has higher debt, which is 29% compared to industry average, which is 22%, and it is not good for the firm. Investors do not prefer to invest in this firm. So for the profitability ratio, Sri Meru Sdn Bhd generate lesser net profit from sales, which is 9.4% compared to industry average, which is 10%. So Sri Meru Sdn Bhd not able to generate more profit relative to its revenue. For the last one, which is asset management ratio, Sri Meru Sdn Bhd restock only 2.66 times, which is not good compared to industry average that restock 4.5 times. It shows that Sri Meru Sdn Bhd not manage their asset effectively in generating sales and collect account receivables.
There are few weaknesses in Seri Meru Sdn Bhd ratio, so I will explain those weaknesses and ways to improve them. Firstly, Seri Meru Sdn Bhd is currently struggling with their inventory turnover, which is lower than the industry average. This can have few negative effects like higher carrying costs and limited cash availability. So, to improve this, they can consider implementing a just-in-time system. Just-in-time system help minimize inventory levels by only receiving goods when needed. It reduces costs and frees up cash. However, implementing just-in-time system requires careful planning and coordination. When done right, it can lead to cost saving, customer satisfaction, and increased profitability. Next is Seri Meru Sdn Bhd is facing a challenge with their average collection period. It takes them 101 days to collect their debt, which is higher than the industry average of 18 days. To improve their average collection period, Seri Meru can take a couple of steps. First, they can tighten their credit policies by carefully evaluating the creditworthiness of their customer. This way, they can make sure they are extending credit to reliable customers who are more likely to pay on time. Secondly, Seri Meru can establish clear credit terms like payment terms and credit limits. By doing this, they can encourage customers to pay earlier by offering discount or other incentive. The other weakness of Seri Meru is Seri Meru Sdn Bhd and their total asset turnover. Currently, their total asset turnover is 1.34 times, which is a bit lower than the industry average of 1.5 times. This means Seri Meru is generating less sales per unit of total assets compared to other companies in industry. Seri Meru can improve their asset efficiency by focusing on its inventory management. It's important to make sure that inventory levels are well managed to avoid having excess or obsolete stock. One way to achieve this is by implementing inventory control system. This system helps monitor demand patterns and streamline procurement processes. As for Seri Meru Sdn Bhd debt management ratio, currently their debt ratio is 29%, which is higher than the industry average of 22%. Now, having a higher debt ratio compared to the industry average is not ideal. This means that a larger portion of their assets is financed by debt. This can put them at risk during economic downturns or changes in interest rates, making it challenging for them to meet their debt obligation. Seri Meru can focus on managing their cash flow better by optimizing their working capital, negotiating better payment terms, and improving their inventory management. They can generate more internal cash. This will reduce their reliance on external debt. Now, let's dive into Seri Meru Sdn Bhd profitability ratios. Their net profit margin is 9.4%, slightly lower than the industry average of 10%. This means they are a bit less efficient in turning their revenue into profit. To improve their net profit margin, Serimeru can focus on reducing expenses, finding ways to cut costs, and streamlining operation. They can also explore pricing strategies to maximize revenue and stay competitive. Increasing sales through effective marketing and sales effort can also help improve profitability. By doing these things, Serimeru can achieve higher profitability. Now, let's talk about return on asset. Serimeru is 12.6% lower than industry average of 50%. This indicates that company may not be generating as much profit from its asset as its industry peers. To address this, Serimeru can focus on enhancing its profitability and efficiency. One strategy is to increase the overall profit margin by exploring avenues to boost sales revenue. For instance, they can expand their customer base by targeting new market and demographics. Additionally, launching new products or services that align with market demand can also contribute to increased sales and improve profitability, consequently enhancing the return on asset. Lastly, let's talk about return on equity. Serimeru return on equity is 17.78%, slightly lower than industry average of 19.23%. This indicates a slight underperformance in terms of generating returns from shareholders' equity. To enhance their return on equity, Serimeru can concentrate on pursuing growth opportunities. This entails exploring avenues for business expansion, such as attracting new customers, entering untapped market, or introducing innovative products or services. By strategically pursuing growth initiatives, Serimeru can improve their return on equity.
My name is Noirina Natasha. I will analyzing the trends in revenue and income and expenses over the last 3 years for the automotive company, which is Volkswagen. The figures for 2020, 2021, and 2022 are as follows. For extra informations, here's the graph of Volkswagen over the last 3 years. Firstly is the trend revenue. Volkswagen revenue has shown a steady and strong growth trend over the last 3 years, demonstrating the company's ability to raise top-line earnings on a regular basis. With 38947 million in revenue in 2020, Volkswagen had a strong financial year. Building on this base, the business had a significant gain in revenue in 2021, coming in at 47241 million, which was a significant rise over the prior year. Volkswagen maintained this growth pathway in 2022, increasing its revenue to 5228 million. Secondly, net income. Volkswagen net income increased significantly between 2020 and 2022, going from 8824 in 2020 to 15836 in 2022. This significant expansion shows that the company's profitability has significantly improved and that cost management measures have been successfully implemented. Volkswagen net income has grown at an impressive rate, which is indicative of their capacity to effectively control costs while optimizing revenue, which has increased overall profits. More specifically, throughout the course of the 3 years, Volkswagen net income increased with figures of 8824 in 2020, 1548 in 2021, and 15836 in 2022, demonstrating a steady rising trend. Thirdly, its expenses. Volkswagen costs demonstrated a steady increase between 2020 and 2022, coming in at 22124 in 2022 after rising from a 9675 in 2020 and 19275 in 2021. This consistent rise in spending points to an increase in running expenditures, which may have an effect on the business overall profitability. Volkswagen may need to take strategic steps to reduce costs or improve operational effectiveness in order to offset these rising costs and keep its profit margin stable. Negotiating supplier contract, optimizing resource allocation, or streamlining procedures are a few examples of such action that might be taken to make sure the business expenses are properly managed in relation to its revenue streams.
My name is Ainin Safia binti Zikri Abdillah. There are some factors that contribute to the changes in Volkswagen financial metrics. Firstly, economic condition plays a pivotal role. In 2020, the COVID-19 pandemic triggered an economic downturn worldwide. High unemployment rates, reduced business activities, and cautious consumer spending had a direct impact on Volkswagen sales. People prioritized saving over big investments like car during uncertain times. Moving on, another key factor is the growing demand for specific Volkswagen models. The company focus on innovation, fuel efficiency, and advanced technology has elevated the appeal of their vehicles. The shift in customer preference towards SUVs and premium models has further fueled the demand for specific Volkswagen models. These factors collectively contribute to the dynamic changes in Volkswagen financial metrics.
My name is Nurul Sahira Betis Babadi, and I will present about the comparison between trend analysis and interfirm comparison. So for the trend analysis definition, trend analysis is a method that utilizes financial report to identify market pattern and estimate future performance. It ensures gathering data from records and plotting it on a graph to find economic pattern. And for the definition of interfirm comparison is the process of comparing and analyzing other organizations in terms of their product or service, financial performance, market position, or any other relevant aspect. Next, trend analysis pattern is to identify trends, circles, or anomalies in historical data from a single entity to existing in understanding its performance trajectory. Meanwhile, interfirm comparison pattern describe how a corporation compares to industry norms and benchmark, identifying areas of over or underperformance. Okay, so for the trend analysis time frame, it usually take medium to long-term focus to analyze historical data. Meanwhile, for interfirm comparison, it requires short to medium-term analysis to comparing recent performance. Next, the purpose of trend analysis is to financial analyze to evaluate trend in revenue, expenses, and profitability. Meanwhile, the interfirm comparison purpose is to comparative financial analysis to assess key performance metrics against industry peers. Next, the advantage of trend analysis is to assist deeper understanding of internal dynamic and performance evolution. Secondly, it can support in forecasting based on historical data trends. Meanwhile, the advantage of interfirm comparison is it provides external benchmark for assessing competitiveness and industrial position. Secondly, it allows for more strategic decision making by identifying areas for improvement or alignment with industry norms. Lastly, the disadvantage of trend analysis is the external industry factors that affect firm trend may be overlooked. Secondly, historical trend may not precisely forecast market circumstances in the future. Meanwhile, the disadvantage of interfirm comparison is the availability and dependability of industry benchmark data are limited. Secondly, it ignores unique conditions that may have an impact on individual company performance. Moving on to the limitation of ratio analysis. First limitation is historical information. So ratio analysis make use of financial data. As a result, it may not represent current market conditions or industry changes. Secondly is inflationary effect. So financial statements are released on a regular basis and inflation might happen between the time gaps and financial accounts do not reflect it. As a result, until the figures are adjusted for inflation, they are incomparable. The third limitation is changes in accounting policies. So, if the company accounting policies changes, this may have a substantial impact on financial reporting. The key financial measures used in ratio analysis are changed in this situation, and the financial outcome reported after the change are not comparable to the result recorded before the change. For the net limitation is operational changes. So, a company operational structure can undergo significant change when large operational changes occur. Comparing financial indicators before and after the operational change can lead to inaccurate conclusions about the company performance and future prospects. Moving on to the net limitation, which is seasonal effect. So an analyst should be mindful of seasonal aspect that could lead to limitation in ratio analysis. Inability to modify the ratio analysis for seasonality effect may result in incorrect interpretation of the analysis result. Lastly, if manipulation of financial statement. Ratio analysis depend on the information that reported by the company in its financial statement to make analysis. This information could be modified by the company management to show a greater performance than its actual performance. As a result, ratio analysis may not exactly reflect the underlying nature of the business because distortion of information is not discovered by basic analysis.